to have a discussion on the PE ratios through an historical analysis of that particular data. Basically, we are doing this to give you confidence both in terms of trading and investment, to identify important zones of support from the fundamental side, and also important to where to pare down, because most of you may be asking that, so okay, I invest, but when do I take profits? One. And second thing, whenever it falls, will it keep on falling? So these are the fears as well as the attitude towards the market. So we need to get more data to convince that these are all areas of where we have got a lot of safety zone, what we call as safety zone investment. That is, you get into a deeper correction and look at the fundamental values of the market, and then convince ourselves that it's a good level to go for a investment buy. Same investment buy, and you can look towards trading either on the long side or on the short side, depending on the values that we are going to present right now. So what are we going to do today is this historical analysis of the PE ratios and also where the market finds support. And if you invest in those particular times when the values come down, then what is the return that you get over a period of 3 years and 5 years? See, as far as the trading is concerned, it is a combination of your skills as well as psychology, right? In the case of investment, I think you're not getting in, getting out, all those things. So you wait through different cycles of the market before you make a decent return on that. So we are looking at the broad market, and those who are very smart will look at some important multi-baggers, okay, within the market. That depends on the deep understanding of a particular company or so. So we are not going into that. That we will leave it to those investors who have the resources and the ability to gather information and take bets on those type of stocks. Right now we will concentrate on the broad market and convince yourself that this market can give you a higher return than the G6 or the FDs. And so even with less capital, can we look towards a decent maintenance of our either retired life or for the growth of the equities that we are putting equity value. When we are saying that, see, let us say it doesn't mean that we have already said that a person who has got 1 crore, okay, sorry, so 1 crore, if he puts an FD and gets a 6%, okay, another person just puts 40 to 50 lakhs and gets 12 to 13%. So even with a lesser amount of investment, earning this extra 50 lakhs is going to be a very, very hard-work task, right? So I'm saying about the savings. So which means another 50 lakhs savings means somebody, even if they save at the rate of 1 lakh per month, the case of 1 lakh per month, then in that case, it will take 4 or 5 years to build this, right? But if it is going to be 50,000, then it's going to be even whopping 8 to 10 years before you come to that. And by the time this money itself can multiply. So, one is that the earnings potential of a person, and second thing is the smart investment. Okay. So somebody would have earned less, might have saved even less, but you would have invested very smartly. Probably luck also would have helped him to identify some important place where real estate you would have done. Then probably getting into the market at the right place, time, and type of stock or those. That is by default it can happen, or that is out of luck. But also by through a methodical study, convincing yourself so that you are not at the fear of investing. Okay. So for that purposes, we need to look at the certain fundamental position values. Now we have already a couple of weeks back, we discussed what is price to earnings. Price to earnings, and we have already given the formula for this. That is the market rate, market price divided by the EPS, earnings per share of the company, gives us the PE. Right? Or you can say PE into EPS is market price. Okay. So if the PE remains even stagnant, but earnings per share growth is good, then in that case you have to have an advance in the market price. So let us say the PE remains flat, the ratio remains flat over a period of time, but EPS grows at 10%, or so, then in that case the market price should also go up to that extent, right? Because of this formula. But what happens is this price to earnings itself now is quite dynamic. It's quite dynamic in the sense there is a base shifting which happens. So for that we need to understand another ratio, that is what we call as the earnings yield. Now you would have heard of dividend yield. This is earnings yield. So dividend yield is what? Now what is the dividend paid by the company? That is dividend per share paid by the company divided by market price, right? So it's a very this one, suppose some company pays 10 rupees per share, and that the company right now the price which is quoting is around 200 rupees. 200 rupees. Then this is the dividend yield is 5%, right? So you're getting 10 rupees for a 200 rupees investment. So there are a lot of shares, good company shares also in India, which are coming very closer to the 5-6%. There are companies which are giving that dividend yield. But most of the top companies, because of the higher price, we may not get this much of dividend yield. It could be something like 2 to 3% for some of the top companies. Because if it's going to come closer to 5% for a very top company, then it becomes a no-brainer investment. So, but there are companies, even sometimes Tata Steel comes in that league. So there are big companies itself which comes in that league. Some oil refinery companies also come in that. Coal India is another classic example where there's a mutual fund portfolio dedicated itself only to dividend stocks. Okay, dividend yield one. So just for understanding purposes, so dividend yield is dividend per share divided by market price. Same thing in the case of earnings yield. It is nothing but 1 divided by price to earnings. So that is, it's an inverse of the price to earnings. So when we say that the Nifty, let us say Nifty has a PE of 20. Let us say if you say PE is 20, then earnings yield is 1 divided by 20, which is 1 divided by 20. It is 5%. On a percentage base, when you say the earnings yield is 5%. Now, this is to a very large extent in India. It is also correlated to what I would say is the interest rate scenario. Now, in 2010, 2011, 12, 13, and all, the interest rates were quite high. So normal, whenever the classic fundamental theory will say that if you want to invest in any stock, okay, it should have a very good track record of paying dividend, all those things, and also this should have an earnings yield which is almost even double of this. So there will be a scanner which will tell you that probably the earnings yield should be something like 8% or 10%. Okay, if that is the case, you pick up those stocks. It may say that. But normally in Nifty, you don't get this particular thing. It comes closer to this 5% which has come right now. So this is to a very large extent is also related to our interest yield. It's a very classic case. I don't know, just for understanding purposes. Suppose if the interest rates are high, what will you do? Suppose if it is 18, if it is going to be 8%, 9% or 10%. Then in that case, your interest in equity market will dwindle for those who are investors. Okay. Because you are getting much higher percent, and assuming the taxes are the same, okay, for just for understanding purposes, there is if there is the taxation rate is the same. If the FDs are going, or if the credit free instruments is going to give 8%, 10%, then in that case, what will happen? The equity market will not fare that well. Equity markets will not fare that well because you, without any risk, you are getting 8 to 10%. So with risk, you are getting 12-13%, you may not be interested. So in that case, what happens? The market price will be a little bit stagnant, or it will not climb steeply to the extent that it is climbing right now. Right? So in a way, this earnings yield has to come very closer to the, or the PE ratio should reflect not only the stock's growth of the EPS, but also should reflect to a very large extent the interest rate side. And in 2012, 13 and all, we have seen the PE ratio something like 15, 16 and all, because the interest rates were at least 2%, 3% more than what we are. So it was, if you are suppose the repo rate, let us say it is 5.4%, that time it should have been 6.5 or 7%, at least it would have been 1-2% more than the present situation, right? So in that particular case, the PE will be slightly lower in order to match that, because if that is around say 7%, or say 6%, let us say even 6%, so this will have a drop which is 20%, so this will come closer to 116 or 17 PE, 16 or 17 PE. So to the extent that the interest rates go up, we will have some sort of a softening of first the PE, and that is what we have seen right now in the market. Right now the PE ratio in Indian market is around 21. It is 21. Okay. Now, so in a climbing interest rate scenario, that is the correlation comes. In a climbing interest rate scenario, you will have a PE compression that can happen. Okay. And in a falling interest rate scenario, we will have a higher interest rate, higher PE ratio. That is why during the time of pandemic, we saw the PE, we saw this PE climbing even up to 34 to 35, because that time ultra money market, money was let loose. It was let loose. Okay, interest rates were down. Now the repo rate started coming something from 4%. It was increased by 40, then 50 and 50. It was 4% sometime back. So that means it is almost 25-30% lower than the present rate. Okay, so that's the reason that time. Plus there was enough amount of money that was being supplied in the market. So it started to climb very closer to 30. Of course, 34, 35 might have been a slightly much higher side. At least the PE should have been greater than 25, 26 levels. And that is why in Indian market for the last 5-6 years, when interest rates were started to come down, because inflation was a little lower and interest rates are low, we were maintaining an average thing which is 25 to 26. 25 to 26. Now the inflation has gone up. Okay, so we are now having a compression which is something like a 20 to 21 PE. So this is the first understanding that we should have, that the interest rate cycle will have its own bearing on the PE ratio also. So you have to make a judgment. Right now the interest rates are going up. Okay, so it may go up for some more time, but whether it will continue to go up for, after some time is something which probably we don't expect it to be. Okay, we don't expect it to be a continuously going up. Probably the interest rate cycle may peak by December, because then the worldwide the inflation can start coming down, and Indian market also probably the interest rates might have peaked, and it could maintain some sort of a stability for some time. It could maintain. So this 5.4% repo can still go up, something closer to 6%. 5.4 can go right up to 6%. And that is almost stacking right now. The interest rates in US has been increased from almost 0 to 2.5, and they are claiming it can go up to 3.5%. So almost from 0 to 3.5%, it's going up. So probably in India it may not go up to that particular extent of 3. So we started from 4. So probably we could end up closer to 6 to maybe 6.5%. Okay. So let us say we should now work with a probability of another 10%. So I'm trying to come to some judgmental value on the Nifties. Now 5.4, so another 10%, let us say we factor it there. So the present thing which is going at 20 to 21 probably can compress itself right up to 18 to 19 to 19. Probably. I don't think so it's going to go much lower. We have seen that in the last so many, I'll put it in the Excel spreadsheet, we have not seen any PE which is much lower than 19.5 in the last 6 years. Since 2016, we have not seen that. Okay. So the question is whether we are going to have an interest rate which is more than the interest rate that prevailed in 2016. Okay. So that is where probably our thinking should be there. Okay. So assuming that no, probably we could go back up to the 2016-17 scenario when inflation was quite moderate. Okay, when inflation was quite moderate, and except for a small brief period when it increased. Okay, so otherwise we were just averaging for a very long period. Our average the PE in the last 5-6 years has been something like 25 to 26%. That means the average repo rate, it was quite stagnant around that 4.5%. For a long period of time. It went up, it was up for some time, then it came down. So now we are expecting probably the repo rate, which is 4 or 5.5%, probably can still go up a little bit, and so factoring all those things, we could probably have one dip which could be the same 19 to 21. This is a possibility, I'm saying. Okay, now one area is that the possibility of a 10 to 15% fall in the PE that can come here, Now, the other thing is that we have to look at the earnings per share growth. Okay, earnings per share, we have been now increasing something like next year also, it's year to year, probably it could be, let us say, 15% growth, because compared to the previous year, we are 15 to 17% more as far as the EPS growth is concerned. Suppose if you maintain this 15% by next year, by end of next year, that is same period next year. So we have something like a 15% growth probably in EPS, and assuming that we have a possibility of the interest rates going up by even 1% more. I think probably it can go by 1% or so. So still that 15, it will be another, say it becomes 6.5% or so. Let us say it becomes 6.5%, which could be another 15% or so from the present level, 15 to 20%, somewhere around that. But if the earnings per share is also growing at this, clipping pace, then in that case the price can become stagnant, right? It can become stagnant. So the worst scenario that we see after 1 year is the present rate, approximately, or something like the worst rate could be 17,000 or so. 1 year down the line. This is the possibility. Okay. Now, because I told you that we are factoring an earnings growth minus a possibility of the PE coming down to some extent, mainly because of the higher interest rate scenario. So a combination of that could still put us only closer to this. So if it bounces lower than this, then it becomes a good buy. Having fixed some value around this, then in that case, what is it that we can expect? Suppose the it is increased to some extent, and then they start to decrease it. And assuming we come back to the same 5.4%, if the inflation is tamed, inflation will get slightly lower after some time. So there is a chance that probably the interest rates maybe increase a little more now, and then can be brought down to the same level. And if the earnings per share growth is around 15%, okay. So what probably can happen is 1 or 2 years down the line, let us say this interest rates comes back to the same place where we are, and earnings per share growth has come to 15%. Then in a 2-year period, we will definitely have a 15% growth. That is why if you look at a 3-year period from now, inflation will start coming down, assuming all the steps are being taken to tame down inflation. If that be the case, we might see a peak reasonably. And then what is the neutral rate? The neutral rate presently they are talking about is the present rate. That is, it is neither accommodative nor restrictive. So they say this 5.5%, because after some time the aim of RBI is to ensure that we get to a median of around 4% inflation, because RBI is supposed to maintain inflation between 2 and 6%. So 4% inflation, if it comes down, or even if it is maintained at 5 to 6%, the interest rates, if it goes up, then probably can come down a little bit. So around 5.5% or so. If this is going to come down after going up, then the earnings per share will take us over a period of time. So even if not 1 year, 2 years down, assuming this has climbed a little bit, in a 2-year growth, we will see 1 year this getting compensated, another year it will move up, and a third year it will still move up. So over a period of time, I think probably we are still expecting that in a 3-year period, if you buy at this level, at least a minimum of 8 to 10% growth in Nifty is definitely possible. But in a 5-year period, definitely, whatever that goes up will also come down. So this will come down a little bit lower. The PE will expand. Now what will happen is the PE at some stage will go back to the average level of 25 to 26 if the inflation starts coming down. Okay. If it starts to come down, it will go back to 25 to 26. That means from 20 levels, we are expecting a 25 to 26, which means that we are straight away getting something like a 30%. 30%. Assuming this happens even over a period of 3 years. 3 years. So you get 10% per annum. Then earnings growth, even if it is something like 8 to 10% earnings per growth, even if it comes there to that extent, then we will have something like a 18 to 20% in 3 years period. So what we are expecting is that the PE will go back to this once the inflation comes under control. Now the steps that are being taken is to control that. So eventually it will start coming down, if not now, by next year or so. So by next year or in the next 2-3 years time, this PE will go back to 25 to 26, which will be a gain of 20 to 30%. Plus we will have this gain also coming in the market of 30% over a period of 3 years. So we will get something like a 18 to 20% per annum. Now what we will do is that we will just whatever we just now tried to explain, we will show it in the Excel spreadsheet. I hope you are able to see this clearly. So now let's look at from this 2016 period. So last 5 years, now what we have done is from 2017 we have averaged out. So in last 2016, the minimum, that 19.34, and this time it came to 19.5. So we are now, so when we talk about the price on the correction, okay, we should also not look at the price alone. We should look at the earnings per share. See, at one day it will go to 19,000 or 20,000. Can we say that no, it is unrealistic? It is not unrealistic. As soon as the earnings per share goes up and interest rates come down, it is not unrealistic. Now, if you look at it in the last 6 years, just to give you confidence, in 2016 February it came to 19.34, and right now in July it touched 19.5. At that point of time, there is a general reaction where probably the market started to go up because earnings also go up and PE has come to the lowest level. See, when it goes up, it's slightly different because the PE it may look very expensive, but what happens is by the time the PE comes down, earnings per share also keeps going up quarter to quarter. So the amount of correction that comes will always be less unless the interest rates are also tightened. Now in this particular case, let us say it has now come to 19.5 where it started to take support. And this year, if you look at it, ever since the interest rate inflation started to go up, we have seen a considerable fall in the PE. So starting now, the interest rate started being hiked in the last 5-6 months aggressively. So from there itself, we see the markets just flattering around this 2021 levels. So it means that 19.5 or 20 approximately is a place where probably it's still willing to settle down. Now, if you look at it, this 21.11, so that means if it has to come to 20, it is a 5% fall. 5% fall in Nifty 17,600 or whatever it is means something like approximately, let us say, 850 to 1,000 points. So any value which is closer to 16.5 to 16.6 from going by this analysis is a very good level for investment. So investment is 16.5 to 16.6. Okay, will bring it the P closer to immediately if it happens, okay, because we are going on a trailing PE. So within the next 2 months or so before the next results get announced. So if it is going to come down to this, then we will have a PE on a trailing basis which will be closer to the 20 mark. And the PE closer to the 20 mark is now much below the average of the last 5-6 years, which is around 25 or 26. Now this 1 by 20 becomes, you get as a 5%, which is very closer to the repo rate. 5.4% is the repo rate. So probably there is a chance that any time it can also slip down slightly to 19 or so. That fear is always there. But we will see the earnings also growing up. See, from now onwards, the earnings for 1 year from now onwards will also has to increase by 14-15%, which gives a cushion. So that means anything if it goes down also, it will start coming up. It will start coming up. So this is a very good, this is the time where probably you need to look at the investment. Now, where do you pare down the exposure? Now, let us say that will depend on a combination of things. So there can be no blind thing. If you see the average of the last 5 years or so, now this is let's say, so we will average out all this. So average comes to 27, and the lowest is 19.5. So we are only 5% from the lower. So maybe because the interest rates have gone up. So as soon as you look at the site of an interest rate peak, okay, the first time the RBI governor comes and says that we are now looking at a neutral stance, or probably the inflation starts falling down in India. That's the time when probably this will start the peak and go back to the 25-26 mark at least. Now we have seen see this 31, 32, 33 and all is the peak of the last year when the pandemic was at its peak, because that was time when interest rates were brought down, right? So if you see this period 2020, that's the time when ultra loose policy was kept. So that is the reason why we saw this PE expanding like this, very because it's not only the question of repo rate, it's a question of excess money supply that was there. So that is what drove the PE to this extent. So if at all there is a problem, if there is a recession, if there is a problem, that is the reason why the market goes up. So there will be a lot of reasons you may be failing to understand as to why the market goes up in a situation like this. It is because the interest rates being brought down so substantially that we have a PE expansion which goes up very significantly, which overtakes even the the EPS growth, right? So now we are not expecting such a, because inflation is major concern right now. So that is the reason we have seen that despite the growth in EPS, now the PES started to fall. The PES started to fall, and it is now for the last couple of months it is stagnating at an average rate. Say in the last few months, it is now at an average of 21.22. We are at the average level of the last few months now. So that means the last few months of average means that we are last few months the average price. It is not a bad situation. It is not a bad situation right now. So the price by itself, it looked as if it has become very hot, but PE wise we are still at an average of the last 5 months. So the lowest could be 19.5, which is another 5% down. So that means we, as the earnings share grows, we should not expect that 15,100 itself will come. It can come probably if the inflation continues to go up. So we have to monitor situation like what's happened in commodity markets, if there is any flare up, all those. And that is why when the oil prices were going up, we were quite afraid. So when the oil prices started to reverse, but still the interest rate cycle is still up because it has not come down to the extent that the policymakers would like to. So probably they may try to get into an excess area of limiting to fight inflation. The interest rates may be even more. So this is what so when do you start paring it will depend on, of course, the highest maximum that we have seen has been if you look at the so maximum average, let's say maximum is this. So maximum average we'll put it. The last 5 years. Maximum average is 34. But we don't need to go right up to that. So once the average that we get, So even the minimum average in the last 5 years has been this. Is 22.21. Even on the minimum side, the average is 22.21. So we are below that. So to that extent, it offers us a comfort. So we don't need to look at going up to the maximum, but we should be looking at least at the average. So average is something like a 26, which we have showed is around 27. The average of last 5 years is around 26, 27. So that's the time when we need to be careful. And look at what the interest rate cycle and other things at that point of time is concerned, because that time when the market is going to flare up to that extent, that means probably the interest rates are also going to hit the bottom, and it looks as if some turnaround situation can come. Okay, because inflated asset market, which is also reflected in the stock market, means it's also slightly unhealthy, and it also fuels the inflation because of the runaway price in asset markets. So to that extent, probably we will see again some sort of an interest rate tightening, which can again bring down the PE down a little bit. But what is very important for us is the PE is a combination more dependent, I would say, on the interest rate cycle also. And the EPS growth is more dependent on the micro situation, where the company's earning matters. Now we have seen, and also here stocks to stock, stock to the index, we have to look at the beta of that particular stock. See, suppose if Nifty is giving a return which is approximately 13-14% per annum, and if tech stocks are returning something like a 20% per annum, we have seen Nasdaq generally giving 20% per annum when S&P gives 13%. So that means it reflects something like I would say 50% or more, right? So approximately 50% more. So that means the P generally can be much higher. So that means we can expect that if Nifty P is 20, probably the tech stocks we can expect something like a 28, 29. So that is the reason why still some of the top tech stocks are at 28, 29, 29, 30 PEs. That is TCS type of stock, which did not come much below the 28, 29. It was expected to come slightly below the 24, 25, but it did not come to that extent, mainly because of this reason. So when you evaluate it, we should also look at in the individual top stocks, what is the beta of that particular stock compared to the Nifty. So accordingly, we should also look at the PE for that particular stock. Okay. So now another point that we want to show you is that suppose if you invest whenever, so this is, I will read it out for you. So whenever you invest, when the PE is between 17 and 21, because it doesn't come below that 14 to 17 and all, we'll just neglect. Even 17 to 21, it doesn't come. But when you get between 17 and 21, so the average 3-year return that you get is 21.19. 21.19. Okay. The minimum, that is maximum is not put, but minimum 3-year return is can be negative, but that's historically done. Okay. So right now it's not there, but historically done. So the average return over a period of time in 3 years is 21.19. The average return of a 5-year period is 18.7. So that is where we are between 17 and 21, and the average 5-year return is 18.7, and even the minimum 5-year return is 8.26. Minimum 5-year return is 8.26%. So you got enough cushion that even if you invest now over a period of 5 years, on an average you can expect easily 18 to 20%, return that you can expect, and in the 5-year period you can also expect something like 8.26% as the minimum, which is much more than probably any deposit yields can still give, right? Okay, with the taxation benefit. So you are in a very good comfort zone for those people who are looking towards investment over a period of 3 years or 5 years. You are in an extremely comfort zone going by this particular tabular column analysis. So this is basically to give you the confidence, that the methodology of selection should be, if it is based on PE, it can be based on price to book value, it can be based on earnings value to EBITDA, AV to sales. So many parameters are there. But if you understand at least one of the parameters in a detailed manner, okay, in an in-depth manner, and try to make your own intelligent guess about the likely macro scenario, because that is a little more easy to predict, in the sense that to developments like inflation, it gets, if it is there, then it goes up to some extent, which leads to monetary tightening. And normally you have to look at what, say for example, US interest rates. US interest rates now, there are certain things which we only when we get into probably reading a lot of things or material that come across, then you will know that to what extent interest rate will go up, and then to what extent it can retrace. Now they're talking about 2.5% Fed funds rate. They consider it neutral. In the sense, neutral in the sense, it is neither. It is finely balanced between growth and inflation taming. But now inflation is the primary target for them, so this will be moved from 2.5% to 3.5%. So another 20-30% increase in the interest rate is possible there. Now, after some time, what the market expects is the 3.5, after having done this up to this, when the inflation starts coming down, the 13.5%, the 3.5% interest will be retraced at least back to 2 to 2.5%. So that rate will be maintained for some time. Okay. So right now, whatever PE that you are getting will be at least the same PE you will get after 1 year or so. Okay, when the interest rates will retrace back. By the time the earnings to growth will be there, the earnings to growth, let us say it's going to be around 12 to 15%. Let us say in US, then you will get a 12 to 15% growth there also. If you get a 12 to 15% growth there, our market index is almost correlated to S&P. Is almost a very, very strong correlation with S&P, which means that we will also grow back at around the 13 to 15% growth. So this is the overall framework. The risk always exists that excessive tightening, which I don't think so it's going to happen that much. So I think just because inflation is running at some high level, I think the tightening will be to some extent. By the time the results of that tightening will be seen, which will definitely create a much more healthier situation. And going by all these guesses, we expect that by next year or so, even if the PE does not expand, if the earnings to growth is going to come back at the same level of say 12 to 15%, we can expect something like 12 to 15% growth on a year basis. And over a period of 3 years or 5 years basis, definitely we expect that probably the PE also will expand and move towards 23, 24 levels, and then we will have expansion of PE plus EPS growth. Both will be helpful. In the near term, there is a possibility of some pullback coming because markets have run excessively. So a 5%, 6% pullback, which is always possible. See, in a bull market, even in Nifty or in S&P, we have seen many times 5% pullback or something like 9% pullback. So in this particular scenario, expecting something like 5 to 9% is still a possibility, because S&P has gone to 4,200 and 9%, something like 350, 400 points. It's around 3,800 or so. If that happens, we will also have a 9% pullback, which could be something like 5% is 850, so 1,400, so 16.2, 16.1, all those things are possible. But more reasonable will be a 5% pullback. If it is going to happen from the present level, it could mean something like 800 to 1,000 points, around 16.5, 16.6, where we feel it is going to be a very finely priced, which will give you enough potential to be on the upside. Okay, this is this we will carry forward because this will give you a great amount of confidence for investment. See, trading is one. Okay, you do the way you probably you psychologically you can withstand, but earning in a very thing where probably you get 12 to 15% per annum, and then pick some stocks or some thing like which has a higher beta than Nifty, probably Nasdaq type of ETF, or in India probably you take a Nifty Tech, this one. You will definitely get a good return over a period of time. So now for the day we will look at what's happening right now, and probably so sorry. So S&P is still on the up. So we are today. Now this is what we call as an island. There's a great gap. So this gap itself is 17,000. High is 17,566. So first of all, we have a very strong support if the market drops down to 17,566, because that's a gap. Now the next important resistance will come at this next level of resistance on this day is this 17,842. So we are now expecting a 17,842 and 17,566. So the immediate thing that we are looking at, it's not moving. Okay. So 17,842 is the next resistance level, and right now 17,550 or so is the support. So this is the level which you are now immediately looking at it, and so those who are long can stay long in the market, keeping 1 minute, sorry. Okay. So some stop loss 17,550 for any long position right now. Okay, with that you can keep moving yourself on the upside. Now as far as the Nifty, Bank Nifty is concerned, again, I think nothing much to even say about it. They all spread, and no, it's all going to be very closer to the not historical highs, but coming very closer to that. So we are looking at the next important resistance is going to be 39,424. So 39,425. As far as Bank Nifty is concerned, the important resistance is going to come at 39,425. And the stop loss for any longs, so since this portion has been exceeded, so we can keep this close, which is 38,635. So 38,635 is the stop loss on a close basis, and with this Bank Nifty can be kept on the long side. So those who are already long can use these levels to remain both on the long as far as Nifty is concerned, as far as Bank Nifty is concerned. And let us look at one or two stocks which have done. We look at Reliance and TCS. Reliance is not performing that well because crude oil is not much moving. So Reliance is a stock probably can stagnate for some time. So that is where the index may not get that much of strength now. Now look at the TCS. So TCS performance is coming almost matching Nasdaq performance. It is also now already up by 11-12. I think from 29 it has gone from 29.50 to 34.22, just 500 rupees. 500 rupees divided by 29.53 is almost 17%. And basically now matching our Nifty or slightly exceeding the Nifty also probably. And see here, say Nifty has come from 15,200 to 17,600. So 2,400 divided by 15,200, somewhat 15%, So TCS has already gone up by 17% from the bottom, which means that probably a little more beta stock it is. So we could expect probably in coming days to probably even outwit Nifty by a couple of percentage points. So probably another 3-4% stronger rally in this year is possible, even without the same thing coming as far as Nifty is concerned. So straight away the stocks are right now, all stocks are generally on fire, US markets are also doing extremely well, and SPX, this is the S&P 500, has only one more level of resistance to cross, which is this level 43.20, 43.50 level. So that's going to be slightly a difficult thing. So we can see some hesitation there. And in Indian Nifty, that's coming closer to 17,800 or so. And let's see whether at 17,800 also it can have some resistance there. So the falling interest rates scenario has to be watched there, and because the interest rates in a Fed will be increasing the interest rate. But what happening to the market expectation? The market expectation is comes from the form of government securities or the U.S. Treasuries. So the U.S. Treasuries are now slightly having gone up to 3.2, 3.3%. It has now come down. So that is the one which is really supporting the market, despite the Fed increasing the rates. So it is the market view which is now dominating more than the Fed funds rate. Okay. So with that, we are concluding for the day. So if you have any questions, please ask. Thank you. So thanks for your participation. So hope to see you next week at some new important topic. Thank you very much. Bye.